Hello and welcome to Cloud9Fin, the podcast where we discuss all things credit, from issuance to redemption, from performing to distress. I'm Peter Benson, I'm the senior private credit reporter here at 9Fin, and I'm joined today by Bill Sacher, partner and head of private credit at Adams Street. How are you today, Bill?
I'm doing very well, Peter. Thank you for having me.
Great. We're welcome to have you. Today, given where Adams Street plays in the market, we're going to talk everything core middle market, or everything sort of sub 50 million EBITDA around there, depending on who you ask. I know we had planned to have this discussion about a month ago, and luckily not a lot has changed since we planned some of these questions, but it does feel like the market is starting to turn. I think, as we talked just before we got on mic here, that there are some deals starting to show up in the market. And I think that's the big question that's been on everybody's mind, is when will deal flow come back? So I guess to start at the high level, where is deal flow in the core middle market just now, Bill?
Yeah, deal flow has indeed improved, but admittedly, it is still below average. I think there are a good number of reasons to be optimistic, but there are also some recent headwinds, too, that are slowing that progression back to normal. The reasons to be optimistic is, one, the pool of dry powder in U.S. private equity funds remains at close to record highs. They sit in committed funds with defined investment periods. It has another two plus years yet to go before the private equity sponsors have to return that capital. So I think the likelihood of that money being deployed before the clock runs out and it has to get returned is very high. In addition, there's some motivation now for the sponsors to actually start selling. The lack of M&A activity has also created a bit of a dry spell on distributions. LPs are beginning to complain, and it has started to create headwinds for private equity sponsors to raise new funds. And so there's some motivation on their part now to start transacting. The last optimistic piece is that the financing markets are wide open. The cost of that financing or leverage is at least 100 basis points cheaper than it was just 12 months ago. And so all the three pillars that you would need for a relatively healthy deal environment are largely in place.
It's nice to hear that there's some optimism. Do you get a sense of when deal flow might come back this year? Will it be later this year? Is it sooner than that? Is it next year?
Yeah, I think the timing is a little debatable. I do think it's within that two plus year time frame. And I'm hopeful that it's sooner than later. But the trade wars, tariffs have created a level of forward uncertainty that has made it a little bit difficult to sell some of these businesses. What's the outlook for the next 12 months? That's the million-dollar question. And it's hard to sell a business with that level of uncertainty.
Yeah, it seems to be one of these things that it was last year. It was all about the inflation and then the subsequent rate cuts happening. And now everybody thought the election would be off to the races, and there has been some uncertainty with the macro. Are there any other reasons, before we move off deal flow, that are causing, especially maybe in the core middle market specifically, that are causing the deal flow to be slow?
Yeah, so they're interrelated. The tariffs and trade wars are likely to be inflationary in nature. Inflation has taken its toll on company earnings. So that doesn't appear to be diminishing in any way. And the geopolitical risks, likewise, don't seem to be diminishing. If anything, they're intensifying, which is adding to the general level of uncertainty and unease with the forward outlook.
Great. Moving on to a sort of specific issue within the market writ large. We cover the upper middle market, the core middle market, the lower middle market. And I think in the upper middle market, we've especially seen a lot of pricing pressure. We actually, in last quarter's BDC results for the end of the year, saw a S plus 400 deal make its way into private portfolios. Thought the S450 would never get crossed. And we have heard the same in the core middle market, that S500 might never get crossed, but there has been pricing pressure. What are you seeing in that realm in terms of the core middle market deals that you're looking at?
Yeah, so core mid-market is experiencing a little bit of elevated competition. Not so much because of what's driving the upper mid-market, which for the most part is it competing with broadly syndicated loans, which is red hot right now. And so those deals tend to price and resemble more of those upper mid-market BSL deals. Core mid-market is less affected by that. The companies generally are not large enough to have access to the liquid market, but it has more to do with supply and demand, where deal flow, as we've just been discussing, is a little bit below average, and the demand for lending remains as high as ever. And so there hasn't been quite enough supply to quench that demand. It is becoming a little bit more in balance. So this spread compression that you mentioned does seem to have stabilized for now. And if we do see a resumption in deal activity, I would be optimistic that at a minimum we'll see stability. We might even start to see a little bit of widening.
No, great. And where would you say deals are pricing right now in terms of the ones you're seeing? I know it varies on risk factors and other stuff, but generally speaking, at the low end, where would you say they're pricing?
Yeah, so I thought the range that you mentioned was pretty accurate. For the most part, it remains in that 550 range, and there have been a few exceptions to that in the high fours.
Oh, interesting. And then it sounds like deal flow might assuage this and we'll start to see a reverse in spread compression. Is that true? Or later on in the year, could we see other things sort of contribute to spreads widening again?
So one of the knock-on second-order potential results of trade war and tariffs is economic softening. We are seeing a little bit of that. We're not predicting a recession, but I do think the risk of one is higher than average and may be intensifying. So with a bit of an economic downturn, on a fundamental basis, those deals get riskier and you should see some spread widening. The central question is that technicals can trump fundamentals for a while. And if we don't see a resumption of deal flow and sufficient supply, you could still see spreads be pretty tight, even in the face of economic weakening.
And forgive me for asking you to get your crystal ball out a little bit, but do we also then envisage, if there is some economic softening, that the rate cuts that the market's been clamoring for, that we maybe see a few more of those this year?
Yeah, I think in a lot of ways we're in very unusual, unprecedented territory at the moment. And I think one of the potential scenarios, which is particularly troublesome, is you could see economic weakness and high inflation, which would make it very difficult for the central banks to conduct real monetary policy to address that softness. That is a set of economic conditions that for most people are in the textbooks. I've actually lived through that. And stagflation can be very, very difficult to address.
No, and I know it's something that we don't necessarily want to go fully on because it's not your or certainly my expertise, but I figure it's something that you're watching because it obviously affects how you guys do business. I guess another thing that's affecting how you guys do business with regards to competition, we have heard, I think, and I think this is especially true in the upper middle market where you're hearing about cov light deals, but even in the core middle market where typically you would get 2 or 3 protections, we heard earlier this year that was going down to 1 protection. Are you seeing documents loosen in your space?
I think how lenders compete can vary, and documentation is just one area where you can compete. We've seen a little bit more stability than weakening at this stage. It's also, while your point is well taken, it's not common to have multiple covenants. We see that in disrupted markets, and we saw some of that during the COVID periods. But for the most part, you get 1 or 2 covenants. Those covenants tend to either be fixed charge coverage or debt multiples. We just happen to favor the debt multiple variety. Those have been pretty consistent and have been at levels that I would describe as relatively normal. Right now, the vast majority, order of magnitude 90% plus of our portfolios have traditional maintenance financial tests, even now.
No, great. And I guess to ask this without asking a question about further weakening elsewhere in deals, but have you seen any other competitive levers being pulled more frequently in the last 2 months?
Leverage levels are up a bit. As you said, creditor terms are a point of negotiation. Spreads have tightened to some degree. Again, less so in the core mid-market than in the upper mid-market. And upfront fees are likewise probably a little bit tighter than in different market environment.
No, interesting. And with leverage levels, how high have you seen them get? I mean, I guess in the core middle market, we typically have seen them no higher than 7 or 8, but have you seen them go higher than that?
Yes, 7 or I remember when 7 and 8 were the purchase multiples, not the debt multiples. But we don't see anything routinely north of 5.5 right now in core mid-market. Just to make the comparison, upper mid-market is definitely at around the 6 times level. And one other area of competition are pro forma adjustments and the tolerance for those. There too, those adjustments are very common in the upper mid-market, and they're getting to the point of being relatively aggressive.
Even in the core middle market?
Less so in the core mid-market. There too, it depends on how you go to market. We are a lead lender, as you know, and one of the benefits of being a lead is that you're coming into the deal before that private equity sponsor actually owns the business, and you're conducting due diligence side by side and sharing all of the information together. At that point, the private equity sponsor has as much interest in making sure that you have an accurate level of EBITDA that you're either buying against or financing against. And so we just tend, by being a lead, not to be reliant on somebody else's highly adjusted pro forma numbers.
No, that's great. I mean, it feels like we could do a whole other 40 minutes on pro forma adjusted EBITDA numbers, but unless
Easily.
people are listening to this in bed and we want to put them to sleep, maybe we'll continue. I guess lastly, you mentioned it at the top, and I do want to sort of end on a more positive note, which is fundraising. It does seem like fundraising is coming back. We at Ninefin have written about a couple of $2 billion fundraisers that are going on in niche areas of the market. How is fundraising going in the core middle market space? How are you guys doing?
It depends on which channel you're talking about. The institutional market for private credit remains relatively strong. Alternative debt is very much popular today, and private credit's probably at the top of that list. So demand side remains strong. There are a lot of managers raising money, so it is particularly crowded at the moment. One of the trends on the institutional side, which is a fairly recent development, is the requirement that the commitment also be accompanied by some level of co-invest. So it used to be talked about with some selectivity by underlying client. Today, it's ubiquitous.
Is that at all levels of the market?
That is at all levels of the market. The biggest source of inflows right now, though, are not coming from the traditional institutional side. It's coming from the wealth channel. And those are the BDCs and the evergreen vehicles. And then the other, I wouldn't describe it as new development, but it's definitely grown in size, is the connection or intersection between private credit and insurance companies. And many of those insurance companies today, as you know, are owned by private equity firms. And that pool of capital is likewise immense and is contributing to very significant, almost unprecedented inflows.
Yeah, the insurance stuff is interesting because it seems like a few of the larger firms, Apollo and KKR come to mind, have bought their own insurers, right, and taken that in-house. Do you see that trickling down into kind of your part of the market, and you will see more insurance and core middle market work together?
I do think that trend will continue. Insurance companies have limited appetite for below investment grade debt, so they're not necessarily investing it in directly. But we've been using securitization technology to be able to turn effectively a portfolio of junior below investment grade debt into mostly investment grade debt and some equity. And so I think that trend is likely to continue. And then the other development in the private market, generally speaking, is the extension of investment areas of interest, one of them being investment grade debt. I think that intersection with an insurance company and their appetite for investment grade debt is the largest single driver to that.
And investment grade private credit has come up a lot in our conversations this year. I presume that, I think investment grade, I think large, I think the biggest of debts. I'm curious if it trickles down to your level of private debt or if it's just something you're kind of watching from afar.
Our interest in investment grade debt is not as high as others, but it is in our market too. And in a lot of ways, this is back to the future. What is currently investment grade debt, which is perceived as a new development, is the old private placement business. When I got out of business school in the mid-'80s, my very first job was at Bear Stearns in the private placement department, and we were generating investment grade debt to sell to our insurance company clients.
There you go. Even as somebody who's not been covering it long, I kind of know the cyclicality of these financial markets. The old stuff always comes back into vogue. I guess quickly to end on the retail capital space, I know that there are a lot of BDCs, again, most of the ones that we cover in the upper middle market, but there are, say, Hercules that does venture debt and Barings that does more core middle market debt. Do you think we'll see more advent of them in your space?
Venture debt, you need a particular level of expertise. Adam Street as a platform happens to have that, so that is an area of interest to us. That is a less scalable opportunity set. It's a much more niche-y business. It's been enhanced a bit by Silicon Valley Bank effectively exiting that business, but the scale of that is less interesting to most managers.
And then do you have a take on the ETFs in private credit? I know we've seen a couple of launching. I think Apollo and State Street have been quite forward and quite in the news about them. Do you see that form of wealth channel being open more to private credit?
Yeah, I think that's the latest innovation on an evolution of the product being sold to the wealth channel. And I think as long as the market remains strong, that trend is likely to continue, yes.
No, it's something we're keeping track of because I'm still trying to wrap my head around how it works, as I'm sure most people in the market are, as it proliferates.
Yeah.
As it proliferates, I can never say that word as a Scottish person, sorry. That, I think, is all we have time for. So thank you very much for taking the time, Bill. This was a great conversation.
Yeah, totally my pleasure. It's great to be here. Thank you for having me.
Thanks. And that'll do it for another episode of Cloud9 Fin. You can find us on all the podcast apps. Please leave us a rating and review. Tell your friends to listen to more private credit podcasts. And until next time, I'm Peter Benson. Goodbye.